Gold's acting quite good right now, as we all know. T-bonds are trying to reassert themselves after the recent pullback low, and stock market's suddenly starting to wobble a bit. We've got some key numbers on the stock market, by the way, that suggest that, in fact, it's around today's lows in both NASDAQ and S&P. You close much around today's lows on any daily basis this month. And we think those two indices are going to start to drop. Not crash, but start to drop and disappoint folks. Like, what's going on here? How come we're back below the 2022 price highs? And that kind of questions. But at the same time, we expect bonds and gold to not turn up, but to advance, to continue their advance that began from last October's low, opposite to the stock market. So I sent you some charts on T-bonds that show the action of the last several years in price going down, yields went up, and the action, especially the last year or two, where when you look at price, you see this arduous downtrend. When you look at the quarterly momentum, let me explain what that is. We measure each monthly bar of T-bond futures, high, low, and close, plotted in relationship to where the current three-quarter moving average is that quarter. And that changes every quarter. Every new quarter, you recompute to what the new three-quarter moving average is. And that's like a 200-day average almost in terms of duration. Well, right now, T-bonds are trading the front month contract, which is June. And even the March is trading in line with where the June is. The June futures are trading above 120 on T-bonds. They close out any month, during this quarter, if they close out a month well above 125, they're going to break out on this quarterly momentum chart. But let's assume that doesn't happen. Let's assume all we see is continued firming here. Next quarter, meaning in 4 weeks, get into April, the structure that they're going to break out on when you look at that quarterly oscillator, which is a flat structure that goes back through highs in 2021, again, early last year. It's like a flat ceiling. You cannot see it on price, but on momentum, it says you go through this and you're going to take off. And that number for next quarter, meaning next month, is 122 area. There's 2 points above where current T-bonds are trading. So another couple point rally in T-bonds, and they're going to engage this longer-term trend structure to the upside, meaning what you've seen on T-bonds for the last few years, which is this staircase decline on the top chart. You see this flat structural momentum. And when that momentum breaks out, that price chart pattern is going to shift upside, meaning we're going to get lower yields. Right now, what have the stock guys been saying? Oh, that's all we want. We want the Fed to pause, cut rates, be party on forever. Okay. They don't do their history very well. You go back to 2000, Tom. Rates have been rising from 1999 to 2000, mid-2000. Fed quit raising rates. Stock market peaked in August of 2000. S&P 500 did its highest monthly close. And in fact, the month before that, in July 2000, the Fed suggested they're going to go flat for a while. Okay, so it was good news. So the stock market had that rally into August. That was the top. In January of 2001, several months off the high and not too far off the high price, the Fed started drastically cutting rates. What did the stock market do? Collapsed for 2 years. Well, the Fed cut rates for 2 years. Let's go to the 2007 top. Summer of 2007, S&P was laboring below its highs that it had seen all during 2007. September 2007, mid-month, 1 month before the price high in the S&P, the Fed cut rates by 0.5%. S&P, oh boy, party on. They went and made a new high in October. In fact, they hit a target zone that we'd predicted would probably be the topping zone. But they partied after the Fed rate cut. Fed continued to cut rates for the next few years. Stock market collapsed.